run strategies, right? You're a partner in an investment firm, along with Wayne. And so obviously you've got a thesis that you're betting on, but I think you'll acknowledge it's not the only risk or opportunity that investors should be contemplating, right? And I'm just sort of thinking about the plight of a typical RIA with, $1 billion or a few RIAs at an RIA firm with a few $1 billion, and clients with real liabilities in the form of maybe it's endowments who've got to meet real distribution obligations, or maybe it's retirees who need to meet educational and retirement liabilities. And you've got global rates near zero and equities at these valuations. I'll let you comment on whether you feel they're high or low and whether there's any merit in that discussion at all. But what are the risks that investors should be thinking about hedging, and how do you construct a portfolio to meet real liabilities in 5, 10, 20, 30 years at the moment that scales, and I don't know how you think about your strategy. Maybe you think about it as being infinitely scalable, or it can be core for all individuals. I'd be surprised, I think, but I'd want to hear more about that. But I guess in general, how should an RIA that's bounded by compliance and regulations and clients with tracking error aversion, but real liabilities they've got to meet, et cetera, how should they be thinking about building portfolios here?
Well, there's an awful lot of questions there. First, I think we're infinitely scalable. We'd like to have that money in $10 million chunks, please. We of course face limitations of scale, but we have built our portfolio to trade the more liquid components of the equity markets. And so we, by and large, are isolating ourselves to the S&P 500 in terms of the constituents that are in our portfolio. Within our portfolio, only about a third of it is actually allocated to single equities. The remaining portion is allocated to more macro securities, including the S&P, for example, which we think has characteristics that make it very attractive in terms of, in particular, misprice correlation. So the last part that I would add while I'm talking about Logica is that I have the luxury of not having to worry about your liabilities, right? That's not my problem, right? I can solve a portion of it, but I don't actually have to tell you how to invest to meet your liabilities. Now, taking that hat off and putting on the hat of a concerned citizen and saying, how do these liabilities get met? I would actually suggest you already know the answer to this, right? You had a guest on a couple of weeks ago who was discussing the dynamics of, look, at the next 10 years, there's no way a CIO can rely on the same sort of return profile that they had previously. And yet we're less funded and require higher returns, and more allocation is going into the riskier portion of the portfolio, with basically the idea that the asset class is going to find a way to deliver it regardless. Now, the irony is that my analysis would suggest that's going to feel awfully good as people continue to pile money in an increasingly beta-oriented or passive way, right? And so you're going to see the prices rise, and then you're going to try to take some money off the table, and you're going to have March 24th, right? Because there's just no bid underneath it, right? There's no incremental buyer in a market that is passive, where you're presuming that the current price is always the right price. Why should somebody increase their allocation at that point, right?
Well, and so again, it goes back to that idea of the value player being the put under the market.
Exactly. It's right? Brilliantly put, Mike.
Totally lacking that.
Yeah, that's exactly. And ironically, we're increasingly shooting that player, right? I mean, we're basically, you're the loser at the table, right? And so, we're going to take you out, right? And again, back to my thesis, right? I mean, if you assume markets are not frictionless, which I would argue very strongly they are not, right? Then firing that cautious person and replacing them with an incautious person who's willing to drive at 400 miles an hour, of course that's going to make markets look better, right?
It's average speed on the it's also going to promote the incompetence. Right, so the CIO, from a behavioral perspective, or the IRA, or the RIA, who assumes that they should have some amount of assets at Logica or at some other shop that's managing the risk, that is having those alternative strategies to put some shock absorbers, is going to be increasingly coming under fire and being fired.
Well, and again, am sympathetic to that, right? Because, and this is again part of the thesis behind Logica, like it's unreasonable to say to that person, hey, you should put your job at risk because I'm telling you that it's a dangerous environment, right? So that's just not reasonable. And so like all the systems are in place. I mean, I've described this. This is a doom loop for active managers, right? The tools that we use make assumptions. Sharp ratio assumes things about the market. Like there is an assumption embedded in the calculation of beta and alpha about the market. And it, I'll tell you occasionally crazy things. I've got my oldest son who's like sliding along the wall behind to make sure he doesn't make it into the camera.
It's happy hour. He can walk by and give a wave.
He's almost 21. He actually joined Mark and Bill and I yesterday, so it was a lot of fun. He's mad at me for bringing him into the subject, but welcome to the world of 20-year-olds.
Embarrass them at any opportunity that you can.
My father certainly did it. I plan on doing it as well. But your goal is to get them to hate you enough that they leave the house, right? So, when you look at the tools that we use for managing managers, right, they presume that there can't be these sort of feedback loops that we're talking about, right? I mean, mathematically, to calculate an alpha or a beta presumes that there is actually a IID distribution that has the same mean and standard deviation over time for the benchmark, right? Well, if the benchmark becomes self-referential and actually exhibits convexity, then mechanically alpha is going to shift negative. And you've seen some of the research that we've shown on this, that this is exactly what we're seeing, right? Well, if you turn around and you say to active managers, well, you have negative alpha, therefore I'm going to fire you, you're just accelerating this process, right? And so everything is set up right now to just destroy it. And then it's further magnified by the fact that the Vanguards and BlackRocks of the world can stand on a fake city on a hill in a soapbox and basically say, oh yeah, we're here for the little guy, right? We're protecting them from the rapacious, asset managers that are trying to charge excess fees for underperformance. And next thing you know, you're passing all sorts of laws and regulations that favor passive, right?
It's the
and
metaphorical
accelerate this even further.
I'm
sorry, what?
It's the metaphorical turkey. It's Taleb's Thanksgiving turkey, right? Where the farmer, the turkey is born, the farmer keeps him safe. Every day the farmer comes in and feeds the turkey. When the fox comes around, the farmer shoos it away. Every day the turkey gets more and more confident in Vanguard and in the farmer. And
he's nurtured until the left tail comes along.
Absolutely, and then it becomes maximally confident right before Thanksgiving, right when the time the farmer comes and chops off its head. And that's really what we're creating in the investment community at the moment.
Well, so part of my pushback against that analogy, and it's not very hard because I actually do think that's right. I think in effect, that's what we will see. But the entire time the farmer knows what he's doing. He's protecting his investment with the anticipation of killing the turkey, right? And so when the farmer says to you, oh yeah, I have such a well taken care of turkey, like you as the observer know what he's actually thinking, right? But the Vanguards and BlackRocks of the world are functionally cults. And they actually believe it's more dangerous, right? They believe they're protecting the investor.
Right.
Right. So and please don't take this the wrong way, but Malvern, PA doesn't exactly attract the stars of the industry, right? It's, this is not where if you're intellectually curious, you don't go to work for Vanguard. Right, you go to work for Vanguard because you want safety, right? You want to be in a good job. You want your mom to be like, "Oh yeah, he works for Vanguard," right? I mean, that's safe. That's you're not going to get the innovative thinkers. I can assure you that I would have lasted about 15 and a half minutes at Vanguard as an employee because I literally would have been, they would have been like, "Yeah, this guy asks too many questions, right? He pushes too hard against the envelope." Yeah. And he makes me feel uncomfortable. Yeah, you're not supposed to ask questions.
How many assumptions are in the
exactly
market hypothesis? And they all have to be 100% true.
Exactly.
Hold on a second. Let me do a probability.